Hey fools, today we're going to be looking at an oil tycoon who lost $34 billion in the last year. We also have a lot of earnings updates to get to you. Welcome to Digging for Value. Hey fools, I'm Joel South. Today I'm here with Taylor Muckerman.
Yep.
Taylor, we're going to start off by looking at headlines. The first headline that you have is from the Financial Times. The headline is Brazil's oil groups fails to live up to the hype. Basically looking at one of the biggest oil tycoons losing a fortune. What's going on here?
Yeah, you look at Ike Batista, been in the news over the last year and a half. One of the most rapid declines of vast wealth the world has ever seen in an individual. $34 billion has essentially evaporated out of his pockets into somebody else's over the last year and a half. OGX is his big petroleum and gas company in Brazil, and it's expected to declare bankruptcy within the week. He's also selling his own private assets in order to kind of pay for some of the debts of this company. And so he's now worth well under $1 billion, and kind of everyone's scratching their head, wondering what the heck happened. And it kind of just likens to the entire Brazilian oil and gas industry. So slow to come to market. You saw Petrobras unleashed some great finds back in 2006 and 2007, and they just now started auctioning off the Santos Basin with their Libra field. Chinese companies were really the only ones that were interested at a high level, other than Royal Dutch Shell and Total. So if they don't go forward with this at a very accelerated level and see increased production, the next auction, which is in 2015, might even be lesser of a hot topic in the energy field, especially now that Mexico is bringing their oil and gas reforms open to the international market. You see Africa catching up. The United States is way ahead of Brazil, so they really might have missed the boat. And if they don't live up to what expectations here in the Libra field, people might just pass by on their oil and gas fields until everything else around the world dries up.
Yeah, definitely. I agree with you. I mean, if you look at Core Lab's earnings report too, they were even looking at the Gulf of Mexico and so many more finds going into that area. ConocoPhillips also were talking about a lot of new production fields that they're finding. Yep. So, if that stuff in the easier plays there are expanding, they're still in a world of hurt to still go out and figure out those new plays, especially the ultra deep water through the salt layers and the rest of it. So obviously something to be watching there.
Yeah, I know. And then you turn from this really slow to market oil and gas industry, and then you look at the United States. Yours from Wall Street Journal talking about big oil's tricky mix of shale and scale heard on the street. This is kind of leading into small independent E&Ps really dominating the U.S. shale market. And you kind of want to talk to us about why they've been so rapid to take advantage of this.
Yeah, definitely. I think it's very interesting when you look at it, because traditionally big oil has the balance sheets where they can go out and get into those huge plays where there's very expensive upfront costs, but they're finding a lot of oil in place, and they have those slow declining curves. So you find a big oil find, and you can scale from there. You can keep growing your production, and with what you already drilled plus the new drilling really builds up into a huge base, and that's really what big oil has been doing. They can't really do that in these plays, and the reason that is a lot of these shale plays have quick declining wells, so basically you're losing, pretty conservatively, you're losing 70% of oil in place after the first year, so you can't really build out that scale, and that's been hurting a lot of big oil companies. You recently saw Shell sell a lot of assets in the Eagle Ford because they don't have that scale, they can't build it out, they want to spend their money elsewhere and getting into some of those expensive offshore plays. And then you also look at companies like ExxonMobil. A lot of the big oil companies didn't think there was as much potential in the shale plays in North America, so they didn't come early to the game and buy a lot of the assets. ExxonMobil had the big XTO Energy deal where they had to spend $40 billion to get into the natural gas game. The timing of that was a little unfortunate for them, but long term will probably work out. So you have to look at some of these smaller companies like Continental Resources, that was one of the first players in the Williston Basin. They purchased so many assets up there and been able to grow their base so much, and like we mentioned, they don't have to have that scale, so you don't have to have that deep pockets to start out. And you can also look at EOG doing the same thing in the Eagle Ford. I mean, these are two companies that have really increased their oil production. They've really returned a lot to shareholders, and the share price of them has been soaring because they were early to the field and they were big players there. So obviously, I really like that, and that's a good way for smaller E&Ps to really compete in the space.
Yeah, you look at a lot of these small E&Ps, they really had a great advantages when they were small companies, they didn't have to show investors as much right away. So they were able to keep a lot of this a secret. And even once it was public knowledge in the mid to late 2000s, these, like you mentioned, integrated oil companies kind of brushed it aside, even though Exxon headquarters is on top of the Barnett Shale, and they didn't even really realize what was underneath them. So you're exactly right. And now I think it's joint ventures from here on out for these guys, unless they decide to snap up one of these E&Ps.
No, I definitely agree. Let's move on to the next headline. What you have, you're basically looking at propane and butane has really been overshadowed by the talk in the LNG. So you're looking at a company or an article, the U.S. shale boom to boost LPG exports, but bringing down prices. What are you seeing here, and what should investors watch? Yeah,
natural gas really takes the headlines when you talk about the energy boom in the United States when it comes to non-liquids plays. But then you look at liquefied petroleum gas and basically looking at propane and butane, like you mentioned. And when we met with Floyd Wilson from Halcone a little over a month ago, he really looked at this market as probably one of the next big booms in the United States. It's really kind of under the radar, and for a great reason. These are byproducts of natural gas drilling. They're the liquids that you see there, but they're used in a lot of different processes, from heating homes and even your gas stoves and things like that. So, and many more products as far as feedstocks in the chemical industry. So now they're going to be exported, and we're actually set to take over Middle East as the top exporter of propane and butane after we've already overtaken Saudi Arabia as the top oil producer. This is just the next thing in line from this shale boom that we've witnessed here, and a lot of companies are taking advantage of it. You look at the Front Range pipeline set to come on in the first quarter of 2014. That's going to be moving some of these petroleum products from the Denver-Euralsburg basin there in Colorado. Really play that I think is going to take off in the next couple of years. A lot of people buying assets there, and that's a joint venture between Anadarko Petroleum, DP Midstream, and Enterprise Product Partners. And once that connects to their joint venture that goes down into Texas, you're going to see that being exported. And then Enterprise Transfer Partners has a joint venture with Sunoco, and they're going to be exporting LPG as well, and that's going to come online here very soon. So you're looking at multiple companies getting in on this, and the Asian markets in Europe are just clamoring for it.
Yeah, definitely. It's really amazing when you look at, we had the huge natural gas boom, and then once the prices dropped, everybody was moving over to either oil or natural gas liquids, so we still have such competitive advantages in the United States, and now that we can start exporting this into a lot of foreign nations where they don't have this huge advantage, it's really fortuitous for everybody in North America and a lot of the companies that can take advantage of it.
Now moving from an industry or a company that's kind of struggling right now with a lot of the announcements they've made, we turn to Encana from Reuters. Here's a company that's cutting their workforce and their payout as gas prices continue to stay low.
Yeah, definitely. It's surprising. Usually you see a company that cuts a dividend. It was 20 cents. They cut it down to 7 cents. Something like that, you usually see the stock plummet. You didn't see that because shareholders know that Encana needs to protect their cash, so they're going out and they're cutting that dividend. They're also going out and cutting their workforce by 20%. So they're really trying to lower their costs, and this is something that they really have to do. They're the biggest natural gas company from Canada, and you've seen one of the larger United States companies, Chesapeake Energy, do the same thing. They basically went out and started cutting a lot of their expenses. They cut their workforce significantly. So the companies that really expanded and had purchased a lot of assets, natural gas assets, when natural gas prices were high, and after the prices plummeted, they really are hurt. So, this is a pretty smart move for them, and they're basically doing the same exact thing that you're seeing from Chesapeake. This last year, they had about 30 plays that they were splitting their money and putting it into. Encana this next year, they're lowering their capital expenditures, and they're putting it all in 5 heavy oil plays, 3 in the United States, 2 up in Canada. So you're really seeing them really be smart here, protect the cash. Hopefully the natural gas prices rise a little bit where they can start making more money from that venture. But they're making the right moves, and that's why the share price today was up. So I think that was a very interesting move for them, and something that a lot of other people, a lot of their peers are also doing in that space.
Yeah, it's actually kind of strange, like you mentioned, investors rewarding for conservative guidance here. I think that that's great. Maybe they're starting to realize that this is a necessary evil right now in the natural gas space. And Encana, one of the largest natural gas producers here in the U.S. and Canada, based up there, but diversified across the multiple geographies. So definitely have to like what you're seeing from management making these prudent decisions.
Absolutely. That brings us to our next segment where we're going to look at some earnings. You've been looking at a lot of the big oil companies. These are companies that have been hurt because of refining. So, are you seeing any companies that are actually kind of above this, where they're not being as dramatically impacted by the refining business?
Well, when you look at it, this kind of ties back to your previous segment of talking about integrated oil companies, except now I'm talking about the downstream. You were talking about their lack of ability to grow upstream because of their scale that they need. But on the downstream end, they're really getting pinched by refining margins as the WTI price closed the spread in the third quarter. So even though they've been able to grow production slightly on the upstream, they've really hurt overall because of this. You look at Chevron really having to reach out internationally for production gains in Argentina, Australia, and even more so in the Gulf of Mexico. But even though production was up 2.7%, their overall earnings weren't because of the fact that their downstream margins were crimped so mightily. But then if you look at Total, here's another company that hasn't been able to grow its production, even though refining margins were hurt. I don't think that these two companies were hurt nearly as bad as an Exxon and a Royal Dutch Shell, who were both down double digits on their earnings. Exxon down 18% overall, and Royal Dutch Shell down an astounding 32%. That company might be in the biggest load of hurt of them all right now, just because they have struggled so hard to really find their direction, even with the new CEO coming on. You mentioned that huge write-down they took in the United States, shale plays down in Texas. So that continues to burden them, even though they do have such wide range of assets around the world. So they're struggling, all of them. You just have to pick and choose which ones you think are going to kind of emerge from this. But with the cyclicality of refining, I'm just waiting for one of these companies to follow ConocoPhillips's move and spin that off.
Exactly. I was just going to mention that, with these companies having that hedge in place, when oil prices are high, your upstream does well, but your downstream is hurt. Vice versa, when prices are low, you can benefit there. So, it might be beneficial. You saw Chevron kind of move that way where they're selling off a lot of their United States refiners in the past few years. But it'd be interesting to see if these companies continue that integrated model going forward, or if they'll start splitting up their businesses like you've seen with ConocoPhillips and also Marathon Oil, Marathon Petroleum, also splitting off about a year and a half ago.
And then changing to some of the smaller guys that are really showing these big integrateds how it's done on the production side, you've seen some positive earnings here from U.S. drillers.
Yeah, first off, I would look at Danbury Resources. This is a company that I like because they have such a long-term potential, and they're basically in the enhanced oil recovery space. And their earnings came in pretty good. They beat by a few cents, but I really still like what they have going forward. The pricing, the United States pricing, oil pricing actually helped them out. They had some issues injecting some of their fields with some maintenance, CO2 maintenance. So that kind of set them back a little bit. But like I said, the pricing helped them win out on the earnings this quarter. Long term, this company still has a number of fields that they're injecting. So you're looking at a lot of their plays that won't reach peak oil production until the late 2020s. Into the 2030s. So you're really seeing a strong inflection point coming up the next few years where they'll start being able to really rip off a lot of free cash flow and return it to shareholders. So I really like them. I really like what they're doing with long-term potential. Another company that I thought was a little bit of an overreaction today was Halcon Resources. They didn't beat on earnings per share. They were down 2% or 2 cents less than analysts were expecting. But if you look over the long term, they had some really good numbers, and they're really focused in the Williston Basin and the Eagle Ford. In the Eagle Ford, quarter over quarter production tripled. So that just shows you what they're doing down there. And what's really nice is the way they're going out and fracking. They're using that slick water frack method that we talked about. And this is showing great numbers. If you compare it to wells that other companies drilled around them, they're producing, initial production is so much better out of this area, and you're seeing a lot of that from the slick water and then also the ceramic proppants. And you can tell a lot of these companies are moving more into that ceramic proppants. Not only are you getting a lot better yields, but you're also seeing what Carboceramics did in their quarterly earnings.
Blew it out.
They were up 30%, and it was because so many people are moving this way. So when you look at what Halcon's doing, I really think that 7.5% sell-off that they had today is overblown. Going 2014, they're lowering their costs while increasing production. So, they're really doing nice things. Their lease operating expenses down 22% year over year. They're looking for their capital expenditures to be down 20% next year while still growing production. So Williston Basin and their Halcon in the Eagle Ford has been fantastic. So I really think both those companies long term, Danbury and Halcon, are still solid companies to buy.
Yeah, I'd place my trust in Floyd Wilson over at Halcon, the first to drill in the Eagle Ford. Where would we be without that field right now? And he was
kidding.
the pioneer. Then you see Papa get in there from EOG, follow suit, and now it's just sky's the limit for that field. And with him in there, who knows how much longer that could really run. And with Carbo Ceramics, I think they've got a great future. So that's all we have today. We talked big and little oil, a lot of earnings still to come. So be sure to tune in Thursday for Digging for Value. I'm Taylor. That's Joel. Take it easy.